My name is Ruth Njuguna. I have been practicing pension for over 10 years now, and I'll just be taking you through the journey of retirement at a simple and understandable level that you can be able to carry some lessons with you. I work with an organization called Octagon Africa. Octagon Africa has been there for the last 13 years, and we have been in the market in terms of providing retirement benefit solutions. You can see our milestones for the last 13 years. We started as a purely pension company. We went and set up incorporated 3 different regions in Africa. We have anchored other benefits, and the latest is that we have an Institute of Pension Management where we train and offer educational programs as far as pension is concerned. And last year, we launched a micro-pension solution called Mobikeza for the informal sector. So basically, that is just an overview of Octagon Africa. Today, we'll be focusing on key areas, governance, how are pension benefits structured, what are the benefits, how do you save, and how are you able to access those funds, and what are the options available. So ideally, even before we start to get into the details of what pension is, I believe that pension is likely to be the most expensive area in your life at the point you are retiring. Perhaps right now we are at 20, 30, 40 and are thinking, 20 years, 30 years are quite far. But the unfortunate thing is that once you get to that part of your life, you cannot turn back the time. And a very good example that I share with people is that currently with COVID, I think this is a pilot test of what you are likely to experience at the time you will be retiring. So if you do not have money, you do not have friends, you do not have family, and you have not invested in your learning, then this is what you are likely to experience. So you better start planning early. And no matter how much you have saved, remember you also have to plan emotionally, because retirement is not just about financial. So once you have the money, you'll need your social circles, you'll need your networks, your health, and all that should also be in place. Ideally, in terms of life as a cycle, there are 6 categories that we all would fall into. The first part of our life is where we are learning, accumulating knowledge. We become adults. Then when we get to a certain age between 30 and 35, we focus on family and career. Then we start to build our wealth between age 35 and 40. And thereafter, there's a cliche that life starts at 40. So that's where you begin to harvest the fruits of your labor. And between age 50 to 75, you are decumulating the wealth either by spending it on yourself or giving it back to the community. And beyond that, it is just appreciation. So before we even get to the nitty-gritties, there are a few statistics that have been done both locally and globally. And we'll start with one that has been done by the Retirement Benefits Authority, who is the regulator for the retirement industry. So a survey was done a few years ago in terms of the sample population were people who had retired and how they were faring on 10 years after retirement. So 31% were still working because they could not access alternative means of income. So they negotiated for extra contracts here and there just to enable them meet ends. Only 6% were financially independent, meaning that those are the ones who had saved, had alternative sources of income, and the rest of the 16% at least had pension, so they were protected, and the rest of the population were depending on relatives and third parties. That's from a local perspective. At a global one, the statistics rather are more shocking, because out of a sample of 100 people, and a survey that was done by the Social Security Administration, which is one of the largest global social organizations in the US, looked at a sample of 100 people as a representative of a population of retirees. Out of that, only 1% were wealthy. Wealthy means they have both pension and other sources of income. Financially secure means they had pension, which means they had an income coming through enough to enable them have financial security. 5% were still working, 36% because of the frustration and the inability to cope with the change had passed on, and 54% were broke and dependent. So you can see only a handful, at least 5% were financially secure, 5% are still relying on income from the employer, which was not consistent. So you can see how bad we are doing in terms of retirement, and we would want to change this. In fact, currently, the United Nations global statistics show that in the next 20, 30 years, 1 out of every 6 people are going to be retirees. So the question is, will you have accumulated enough such that you are not part of the 16% in question? When you're looking to save for retirement, there are normally 3 items that are key for your consideration before you start. One is adequacy of the savings that you will have put in place, sustainability of funding those benefits, and the income that is generated by the savings that will be invested. So adequacy, sustainability, and income go together when you're planning for retirement. So once you have considered those 3 things, the benefits of the outcome of that would be financial freedom, especially at retirement. There are tax advantages that are associated with retirement benefits. So you look at how much tax am I likely to save, and if I was to consider the tax, what is the equivalent of the contribution for me to get the maximum tax advantage? The impact on compounding and smart investing on your net worth. Remember, you doing it on your own is not necessarily the smartest way. You need professionals, and you should need to be seeking advice from professionals for you to know the better route to get maximum benefit. The good thing about pension is that it probably is the most safest investment you'll ever come across in Kenya. One, because it is set up as a separate entity from the employer or the entity that sets up that trust. And 2, the funds that accrue from a retirement benefit scheme are held under what we call nominee accounts, which means they do not form part of the balance sheet of the bank. And if anything were to happen to the financial institution, you would still be able to access your funds thereafter. And most importantly, with better health needs, medication, and lifestyle, people are living longer and are outliving their savings. So it is important that you have a backup in terms of what the outcome of your retirement would serve you. In terms of the governance of retirement benefit schemes, they are set up as a trust, like I said, which is an independent trust from the organization setting it up or the employer in question. So it is managed by what we call a board of trustees. The same way a company has board of directors, a pension scheme has what we call boards of trustees. So these trustees hold the assets on behalf of the people who contribute, so that they are independent in terms of making decisions in the interest of the beneficiaries who will be the members who are contributing. The structure further defines that every pension scheme in Kenya and regulated by the Retirement Benefits Authority must have 4 parties in question. A custodian is a bank who holds the assets on behalf of the trust. Fund managers are professionally licensed by the Capital Markets Authority for the purposes of investments, and they invest professionally. They should have met certain requirements and are also licensed and regulated by the Retirement Benefits Authority. We have auditors for obvious reasons, just to independently review the books of accounts and ensure that they are proper, and actually for the purposes of determining risk and investments and profiling which investments are suitable for what age profile. And an administrator is basically at the center of it all. We call, or rather are equivalent to an operations person. Theirs is to keep records, share statements, process your benefits, and all that. And of course, the key party in this structure are the members who contribute. A member can be active, meaning consistently contributing year on, or deferred member, which means you have funds, but you're not consistently contributing, and what we call pensioners who have already retired, but are drawing money from a pension structure. What are the options as far as retirement is concerned if you want to invest? Before you retire, there are basically 4 key components. There is what we call the statutory fund. This is the National Social Security Fund, which is everyone, or is statutory for any employer who is registered. And normally we contribute 200 shillings each, both from an employee perspective, and if you have an employer, they also contribute 200, but if you're doing it voluntarily, you just do 500. There is what we call occupational schemes or umbrella. These are retirement benefit schemes where employers set up for the benefit of the employee. So they can either contribute jointly with the employee or they contribute alone. Alternatively, we have small and medium-sized enterprises which have similar structures, but they come under what we call an umbrella because we pull them together to maximize on returns and minimize on costs. So those are called umbrella funds. And we have what we call a personal pension plan. This applies to any individual for as long as you are willing and have identification, or you are registered as a Kenyan citizen, or if not, you have documentation that you are an adult, you can comfortably contribute as an individual just to enhance your benefits at retirement. Then we have what we call PRMS, or what we call the post-retirement medical scheme. You consistently contribute for the benefit of your medical insurance after retirement. So the same way you contribute into a pension plan, you contribute to this particular fund, but the objective is different because it is targeted at medical benefits. Post-retirement, which means after you have retired, the 4 items above are converted into other structures, which can be an income drawdown, annuity pension, or still a post-retirement medical scheme, but this time around drawing money from the fund. And for the post-retirement, I cannot go into the details because it is covered later in this presentation. Other than that, there are several tax advantages on retirement. That is why we encourage people to put in money, because the government understands that later on in life it is challenging for us to access money. And you can also see the government is struggling with the same. One, for the national treasury, the burden in terms of paying retirees for civil service has become too huge, and it is one of the largest components within the Kenyan budget. Other than that, there is a 2,500 cash transfer on a monthly basis to old people, and the equivalent of that on a monthly basis.
Just 1 minute. Lennox, if you could kindly mute yourself. Thank you. Ruth, you can continue. I think you need to repeat the last few lines.
Yes, I also got confused.
Yes, thank you.
So there are various tax advantages as far as retirement is concerned. And the reason why the government is giving this preferential treatment is that they are also struggling as far as policy is concerned. One, we have consistently witnessed civil service pension, a growing burden within the budget, the national budget agenda, and it is the fastest and largest growing item. Over and above that, we have the 2,500 shillings cash transfer to old people that is equivalent to close to 1 billion shillings a month. Those two are enough for the government to just give a few advantages so that people are encouraged to save more in the long term. So there are 3 levels of retirement. 1 is at a contribution level, 2 is on income, and 3 is on the benefits at the point you are retiring. So at a contribution level, any person who is a member of a retirement benefit scheme is granted 20,000 tax-free contribution into a fund, which means if, say, you are earning a salary of 100,000, we will treat 20,000 as a tax deductible element. Therefore, 80,000 is what will be subjected to pay. And it is assumed for every 1,000 shillings that you are saving, every 1,000 shillings that you're contributing into a retirement fund, you save at least 200 to 250 shillings, depending on your level of income. Income on registered funds. So the income that is accrued from the contributions into a pension fund. Normally, income from any business should be charged income tax at 30%. Therefore, the income accrued from the contributions into a pension scheme, the 30% is waived. So that is the second level of tax advantage. And lastly is at the point you'll be accessing this money or retiring. For every single year you are a member of a pension scheme, you get a tax relief of 60,000, subject to a maximum of 10 years. But over and above these three, the graduated scale for pension benefits is far much more lenient than a pay bracket. Actually, 3 times far much more lenient than the normal pay tax bracket. So you can see, if you get to accrue any tax advantage at each level of your phase towards retirement, you'll realize that by the time you are 60, you probably will have 50% of all your benefits tax-free. So that is how you need to benefit in terms of tax advantages. Sorry. Oops. So a basic illustration in terms of pension savings. If you decide as a member today, you save 2,000 shillings in a month, and we assume that the escalation rate in terms of the 2,000, on an annual basis, you'll be increasing this amount by 10% just to cover for, say, inflation. And in terms of the interest, I have populated from the minimum, which is 4%, to maybe a maximum of 12%. Remember, pension benefits, you look at them from a long-term perspective, and mostly in a period of 10, 20 years, the average return would range from 10 to 12%. So consider someone who is saving 2,000 shillings. 2,000 shillings basically means on a weekly basis, 500 shillings, and on a daily basis, that's 100 shillings. And I believe within the category we are in, we are able to afford that. The social life, the money we spend on pizzas, impulse buying, say, clothes and shoes for ladies, the money we use to entertain our friends is far much more than the 500 shillings per week, or rather 2,000 shillings a month. So in a period of 10 years, if I assume a long-term interest rate of 10%, it means in a period of 10 years, you'll have 600,000. 15 years, you'll have 1.5 million. In 25 years, you'll have 6.5 million. And in 30 years, you'll have 12.5 million. Retirement is aimed at the long term. So if you're most people start to work at the age of 25 to 30. So you have 30 years to retirement, and we are assuming that you will probably contribute for the next 25 or 30 years. And with a return of 10%, you see that the minimum likelihood is at 2,000 shillings is going to be 6.5 million, and at 30 years is going to be 12.5 million. And if you do higher than that, it means then the benefits are much more likely to be larger. What does that translate to? If in 25 years you'll have contributed the 6.5 million, for instance, the replacement at the point of retirement, it is going to be an equivalent of 65,000 per month. And I will show you how we arrive at that. But basically, if you were to populate this using a retirement calculator in terms of monthly savings, equivalent to 20, 30, 40 years on your retirement, you realize that the game changer is time and also the compounding effect associated with the investments. So it's very important to note that as you're saving. Once you have saved, what are the requirements, or rather what are the grounds for access of pension benefits? As far as legislation is concerned, these are the grounds that you can access benefits. If you leave your employer, that is if you're contributing jointly with an employer. If you're contributing on your own, you can be able to access your money at any point in time. That's through a personal pension scheme. But remember, the earlier you access the money, the more punitive tax is going to be on your benefits, because you do not get the full advantage of taxation exemption, and you also do not get the full, you do not get rather the maximum benefits associated with investments and the compounding effect. So you are able to, if you have jointly been contributing with your employer, you can access your money at the point you leave service, but you would be restricted to your own contributions and 50% of the employer. In terms of other grounds before retirement, there is ill health, but ill health means you have to prove beyond reasonable doubt that you are not able to physically or mentally be able to work for the rest of your life. So it's more like permanent disability, either mental or physical. But even that, you need an approved certification from the Ministry of Health or from the doctor in question, or a medical report certified to confirm that position. If you're relocating to another country, you must have relocated, apply for your benefits, but you have to prove, or rather provide proof of citizenship, which ultimately shows no intent of coming back into the country. At retirement, you are able to access everything, and in my subsequent slides, we'll cover how you are able to access those funds. There is also one aspect that members probably are not well versed with, and that is called transfer of benefits. One, every time you change employment, you are able to transfer your benefits from one occupational or umbrella fund to another. There is no taxation because you are not accessing the money, you're just moving it from one employer to another. Two, you need to be careful that the funds are being transferred to a registered pension scheme. So how do you confirm the scheme is registered? You go to the Retirement Benefits Authority website. They have provided a listing of all registered pension schemes. And if you are not sure, you can always ask your employer to give you a certificate confirming that position. So when you're transferring benefits from one employer to another, you just need to know who are the service providers from each fund so that the money moves from one employer to another. And for that process to happen, you must always issue authorization to your former employer requesting for those funds to be transferred. There are normally, as we move in, the first phase of what we have covered is when you're contributing towards retirement. So what happens when you get to retirement? There are 5 stages of retirement according to Social Security Administration. So you go into different phases before you can get to retirement. So 16 years into retirement means that you are relatively content and you have the benefit of longevity because you still have some time to save. The normal recommended age for you to start retirement, attending retirement planning sessions is normally 15 years into retirement, with a gap of every 5 years doing a refresher for you to be able to analyze your position and look at what you need to adjust. So 15 years into retirement is the reorientation process. So you are slowly transforming into a new phase of your life, which is challenging because you need to have a lot to start building if you had not started saving before. First day to first year into retirement is, of course, you're excited, you are relieved that, the burdens you had been carrying financially or maybe work related are over. But remember, even after retirement is a phase. So when I started, I said retirement planning is not about financial freedom alone. It is about being emotionally prepared and everything that comes with it. So between 0 and 5 years after retirement is that we're excited, we are hopeful and worried at the same time if we are financially liberated or we have completely integrated into the community and whether we'll be able to sustain that life. And of course, 6 to 15 years into retirement is excitement, enthusiasm. For some of them, they're miserable because they are not aware of what the issues are. In terms of modes of access of benefits, this is at the point you have retired or you have left service. So how are you able to access that money? You can either access it in form of a lump sum. So there's going to be the tax-free cash and what is going to be charged tax if you have exhausted the limits provided by law. The other mode of access is what we call pension or income drawdown or annuity. Pension means you'll be accessing your money in form of a monthly payment, which is the equivalent of your salary when you're still working. Pension and drawdown and annuity in terms of their objective is the same. It is just how they are structured and the target that is different. Pension mainly is payable by the government for civil service and other old mechanisms of pension schemes. Annuities and drawdowns are paid by insurance companies and other financial institutions who are licensed to provide that, and they come in terms of flexibility and depending on the need of the individual. So for you to be able to determine how much or what is relatively sufficient for you at retirement, there's what we call the income replacement ratio. This is a person's gross pension after retirement divided by his or her gross income.
30 minutes later.
Sorry. For instance, if you are earning a salary of 100,000 at the end of your working life, and your pension then is at 60,000, it means then your income replacement ratio is at 60%. International global standards, and specifically the International Labour Organization under the United Nations Social Security Program, advises or rather recommends an income replacement ratio of 60%. That is a good position to start with at retirement. Unfortunately, in Kenya, the average income replacement ratio is at 20%. So it means we still have another 40% for us to breach. And that only covers a population of like 3 million, 15% of the working population. So if you wanted to confirm how much you'd be able to get at retirement, if we were to convert your current pension net worth, is we look at your monthly and then compare it to the income replacement ratio. Remember, I said the ILO recommends 60%, and whatever you have, we convert it into monthly pension or an annuity or a drawdown. So assuming you are at 60 years of age, this is just a basic illustration. The purchase, you have 1 million shilling. 1 million shillings is your net worth in terms of your total savings and for retirement. So we call it the purchase price because that is what you will transfer into the income drawdown fund or the annuity for you to get an equivalent of a monthly pension. Gender also counts in terms of how much you're going to get. Males are considered to have a shorter lifespan, so we give them a higher amount because they will outlive, they probably will not outlive, and we would like them to enjoy before they pass on. Females are considered to have a longer lifespan, so their benefits are slightly lower because they're expected to live for a longer term, and therefore longevity is far much higher. So if we were to convert the 1 million shillings, you will realize for a man is going to be around 10,000, and for a lady is about 9,000. And normally the easiest way to be able to confirm how much you'd be able to get in terms of monthly pension, just use 1%, or rather convert 1% of your purchase price. That's just on a general level. There is nothing fundamental or mathematical about it. But normally your equivalent monthly pension should come roughly to that estimate. And if you look at the figures down there, they are almost equivalent to the 1%. So if this person was earning a salary of 100,000, it means then their income replacement ratio is at 10%. I believe that is far much clearer. Over and above that, there is the other aspect of medical. Remember, when you retire, your medical needs don't retire. People will invest heavily in financial income, but they forget that there is the other aspect of medical insurance, which the employer will not give you after retirement. So we have what we call post-retirement medical schemes, which are anchored on pension products, which means
Can I call you in the next 45?
which means you're slowly contributing into a fund for the purposes of coming up with a pool that will help you provide for your medical needs. So there are 4 ways of funding that kitty. The law allows that the same be anchored on your pension, or you can get an alternative pension provider who has that particular product. So there is the first aspect of voluntary pre-funding. So on a monthly contribution over the long term, you contribute either 500, 200, 1,000, 3,000, and each of the providers will give you a sort of calculator that shows at your age what is the recommended monthly contribution to enable you achieve the objective at retirement. So you can voluntary pre-funding. Then there is target, where you know you would want to achieve a savings of 10 million and you contribute towards that particular kitty with that in mind. You can also, the law allows that at the point you're retiring, if the fund you're contributing into is registered by the regulator, then they allow you to transfer up to 10% of the total net worth into a medical fund, which means if, say, your medical kitty is 5 million, then you are allowed to transfer up to 500,000 into that medical kitty for the purposes of funding your medical retirement. But if you are pressed with age, because maybe you are age 55 and towards age 60, and you just learned about this product the other day, then insurance companies have pooled products where you fund on a cash basis. You pay premium that is used to fund your medical needs. But that is a very expensive affair, because remember, you will not always have that amount of money then, and medical covers for retirees is very expensive because older people seem to have more risks, and the insurance company will always appreciate that risk by increasing the premium. So those are the 4 alternatives when it comes to funding your retirement needs. So how do you access your benefits at the point you are retiring in terms of medical? So you can either convert your monthly, you draw money from your pool and pay insurance premiums on an annual basis. Remember, the good thing about a post-retirement medical fund is you only draw the amount equivalent to the insurance premium. So the rest is still left within the post-retirement medical fund. It is reinvested and you still benefit. In fact, if you were to practically do it, you will realize that the income that you accrue from the capital investment is sufficient to fund your medical needs, or rather your premiums on an annual basis. So investing in advance makes much more sense, so that the capital value regenerates into more money and you do not have to subsequently look for alternative sources of funding your medical needs, and you still have other needs perhaps then. Or you can have a medical drawdown where ideally you just take money to fund your medical needs instead of going through the insurance company. Or you can have a hybrid where you have a combination of both payment of insurance premiums or medical drawdown. So you have part of your fund paying insurance premiums, and part of it, anytime you have a medical emergency and you have exhausted your insurance limit, then you can draw money from that fund. Time is always a game changer in all this. And this is just an illustration of a post-retirement medical scheme in terms of if you were to fund contributions on a monthly basis, how much would be sufficient for you to cover that. NHIF are also coming up with products that can be anchored for the purposes of that particular benefit. So as I wind up, what are the recommendations and the way forward in terms of what you do in retirement and what you don't? So I'll start with the don'ts. First, make sure you do not live or get into debt at retirement. So when you're at 55, don't get debt because you'll not have enough income to repay the obligation and also sustain you. So between age 40 and 50, or rather between age 50 and 60, ensure that if you have any debt, you hasten the process or tie it into an income stream so that by the time you're retiring, you do not have debt. If you have a mortgage, ensure that you pay it before then. And if not, then you will have to convert only a portion of your retirement money to offsetting the mortgage or whatever liability it is, not your full amount of retirement. Retirement benefits regulations allow for you to fund purchase of a house using retirement benefits, but of course there is a process currently and there is an assessment. Once you meet the minimum requirements, you can be able to access that. But the amount in question cannot be used to settle your mortgage obligations if the outstanding amount is more than the retirement benefits. And the reason why the law was structured that way is to ensure that we do not have a double tragedy where you are losing both your house and your income. So don't depend on third parties for your retirement. Don't imagine that because you have children and you have educated them, they will take care of you. No, we know what the current generation is like. They are not perhaps dependable, and even if they were dependable, you are not sure whether their financial needs will be lower enough to be able to accommodate you. Do not assume that you will work into eternity. We are currently seeing with the current job changes what is happening. People are being laid off. Sometimes some uncertain events occur and you're unable to work. For instance, you can perhaps become permanently disabled and you're not able to work. Perhaps your spouse passes on and that is the only income that you guys were depending on. And sometimes the organization is still there, but your income is reduced because of certain, especially like hospitality industries, which are based on how the economy is moving. Never invest without seeking professional advice. We have a tendency of assuming that we are experts in everything. We put our money based on what we think, but not necessarily guided by any fundamental facts. If you look at the richest people in the world, they advise that never invest in what you cannot understand. So if you cannot understand it, seek professional advice, and if you can't, then move to the next alternative. Don't ever focus on the short term. Retirement benefits are anchored on the long term. What normally happens is that people panic when the markets start to go down. So perhaps the equity market, like right now, is close to is down negative 15%, negative 10%. What people do is start to draw their money. But what you're essentially doing is, remember, your capital has gone down. You removing it makes it worse. So you need to focus on the long term, let the markets recover, and over time, of course, the economy always has its shocks, but there is a way it comes back to the neutral. Never invest in illiquid assets, especially if you are not sure how to dispose them off or when you're nearing your retirement. I know we Kenyans, Africans have got emotional attachment to property, but the truth is we do not trade or use that. We never use those properties to make more income or to generate value. So you'll find families with a lot of land, they have been holding on to the land for 10, 15 years, not generating value, but just holding it because it's ancestral, because they have a certain attachment to that investment. And most importantly, never hide information from your loved ones. Remember, when you pass on, this is the money that is left behind, and because we are unable to trace the beneficiaries, it is transferred to the Unclaimed Financial Assets Authority, and in a period of 7 years, if we are not, the government is unable to determine who is the beneficiary of those funds, the money is automatically used for government infrastructure and any other projects. What do we recommend that you do in retirement? One, have clear retirement goals. If you are at age 30, age 40, age 50, first is to analyze your current position. Am I at 5 million? Am I at 500 shillings? Am I at 100,000? And what do I need for me to get to my objective? Normally, if you engage financial experts, they have what retirement calculators. And these days with Google, you can always go use an estimate. Perhaps you would want to have a conversion ratio of 70%. Get into the retirement calculator, get your target, and that will give you a base as to how much you need to be contributing on a monthly basis. And if you're not able to do that, then engage a professional advisor and they will show you or rather they will guide you in terms of your retirement goals. Maximize your savings. Every time you get a windfall, ask yourself, is it necessary for me to spend it now? If not, put it in any form of investments for a rainy day. Ensure that you keep an emergency fund because emergencies don't come with a notice. We have all seen, case in point, COVID. It is the whole world that is reeling from emergencies. And if you didn't have enough money, like I said, this COVID period is a pilot program of what will happen to you in retirement. Diversify your income sources. You have pension, you can hybridize, you have high risk investment, low risk, medium term, so that on average you have a good net worth for you to be able to cushion you at retirement. Understand product benefits. So once you seek professional advice, understand what each product brings to the table. There is one for medical, there is one for income, there is one for bridging your emergencies. So understand each product and understand what each product aims to achieve in terms of objective. Then consistently track the progress of your goals. If you had anticipated to have 5 million at the end of 10 years, are you able to confirm that within those 10 years you have achieved 5 million? And if you have not achieved, why were you not able to achieve that? And what is it that you can do in the short term or long term to achieve that goal? I can tell you for sure, most of us, even when the employer is contributing on our behalf, we have never bothered to confirm whether our payslip is consistent with the contribution rate, and we have never bothered to confirm whether the actual amount that is being deducted is what is being remitted. Another example would be all of us contribute towards NSSF. How often do we go and check with NSSF that indeed our employers have been meeting their share of obligation, and whether we have even bothered to go and look for a statement and confirm how much? Because it is also part of the diversification. and most importantly, take advantage of tax benefits. Tax benefits does not necessarily mean just retirement. There are so many other tax advantages apart from payee. There are tax advantages that come with life insurance. There are tax advantages that come with mortgage. Have we exploited these tax advantage benefits through our employers and in terms of the contributions that we make? There are so many tax advantages, and if you look at how people achieve their financial goals, they convert the tax benefit and put it into an investment fund, and it becomes part of the diversification, or it becomes part of the emergency fund. In fact, you will realize the 2,000 shillings that I had illustrated in terms of monthly contribution could account to 100% of the tax savings that you benefit in all aspects of taxation. And maybe that is the starting point if you haven't been contributing. And most importantly, retirement is not just about financial. Remember, there is the emotional aspect. Over and above the emotional, there is health and wellness. Health we have covered through post-retirement. Wellness is exercising, eating well to ensure that you have a longer lifespan and you fight off diseases. There is the other aspect of succession planning and estate planning, where have you drawn a will or looked for an alternative mechanism for your successors in terms of investments? And if you haven't, how do you avoid scenarios where at the point you pass on, your beneficiaries are either suffering because you did not put your estate in place, or they have no access to the benefits that you had been saving through your lifetime. So there are trust funds that can help you, especially with minors, and there are also trusts that can help you with estate planning. So those are considerations. Family and relationships, remember the point you are working or you're in business, your associates are your relationships, but benefit from them in terms of networking. But remember, there is also family. So beyond your career, you'll only be left with your personal relationships. How are you able to generate value from those relationships? Either your networks, perhaps at the point you are retiring, you are a consultant. Are the networks you are engaging with during the life of your career, are they going to open up avenues for you to keep you engaged? They say you are 6 degrees away from your most important relationship. So evaluate the 6 people around you and see what value they bring into your life. Social and community. Most of us at the point we retire, we move from urban centers to rural centers if we do not have enough income to sustain us. Have we integrated into that community? Are we able to provide some sort of social network within that community so that we are not left out? And most importantly, are we able to give back either in terms of time, in terms of talent, and even financially if we can at the point we are retiring, so that it gives us satisfaction? I think that basically covers the importance of retirement and what you need to know then. Thank you. And it's now time for Q&A, if there are any.
Oh, there's so many, Ruth. Thank you so much. I think we can start.
Yes.
There was one that started just after. Oh, yes. What is your view on the proposed tax on pensioners, and how does it relate to the tax advantages you discussed?
Yeah, very, very good question. My view is definitely it is a bad idea to tax people at retirement. Previously, what was happening is that anybody who had attained age 65, your benefits were completely tax-free. So the new budget proposal was they introduced an aspect of tax on that amount. But I think progress has been made, and we are looking towards having it reversed to go back to the position it was on, tax-free at age 65 and above.
Okay. I hope, Richard, you've been answered. The next question is on the transfer of benefits. Does it apply to the employer's contribution? And in that, will it apply if the transfer is to a personal pension?
Yes, transfer of benefits applies to any form of pension on condition that you have ceased to be an employee of that organization. But for personal pension schemes, because they are not affiliated to any employer, then you are at liberty to transfer it at any point in time, especially if the governance structure or the return is wanting. The only limitation on transfer of funds is on the statutory fund, which is an SSF. But any other, for as long as you have left the services of that employer, you are allowed or you are at liberty to transfer it.
All right. Can we have more than one retirement benefit fund, say besides the employer scheme?
Yes, you can have more than one retirement fund. Individual pension funds, you can have as many as you can, for as long as you have the financial capability to fund them and they are registered by the Retirement Benefits Authority.
Okay. And I can also add, you also try and take the tax advantage there, because
Yes.
I think you had played the limits. You had
Yes.
discussed the limits.
Yes, yes.
Okay. There's another question from Veronica. Can we do early withdrawal more than once? If
Rose,
one has job? Yes.
Just give me a second. I'm getting some distraction. I get back to you in a second.
Okay. Okay. Keep the questions coming, as many as we can. We shall share the presentation at the end of the day. We are also live on Facebook, so you can ask your friends to join in. Sorry,
I'm back.
All right. So the question from Veronica was, if one can do more than one withdrawal. Let me just get, can one do early withdrawal more than once? And say if one has switched jobs.
Yes, but that is dependent on the situation. And just to explain that is, when you have been contributing to an employer fund, you have an opportunity to withdraw your contribution in full and your employer up to 50%, as long as you have left the services of that employer. Sometimes you find people at the point of exiting, perhaps they do not need the full 150%. So they come and access the 50%, come back and access another 100, for as long as you have not exhausted the limit as guided by law, you can. And for as long as you have left the services of that employer. However, depending on the structure, sometimes there are administration charges associated with the management of the fund. So every time you access, there might be a charge associated with it, and you need to find out if it applies in your case. For individual pension plans, where you are fully contributing on your own, you can access as many times as possible. However, there is also an element of administration fees that may apply at the point you're accessing it, and sometimes to discourage people from frequently accessing and reducing the target retirement income, you will find that some financial institutions rather would tell you cannot access these funds within the first 1 year or within the first 3 years. And if you access it, then you lose interest, or we will charge you a penalty of 1% or 2%. So it is important to understand the fine print before you can access the money multiple times.
Okay. It's actually a learning process for all of us, especially when it comes to that, yeah. There's also another question. How are savings treated if the retiree passes on before drawdown?
Yes.
Pardon, repeat. I can't hear.
Just a minute. Let me try and get. I am not sure. Okay.
Yes, now it's okay.
It's okay now. Yes. How are savings treated if the retiree passes on before drawdown?
Okay, very good question. In fact, I forgot to touch or cover on death benefits.
Yes.
So what happens is at the point you join and start contributing into any retirement fund, you are required by law to nominate a beneficiary. So over and above the application process, you will be required to nominate a beneficiary, outline the list of the beneficiaries, showing the relationship, and even to the extent of showing an allocation in percentage of what net worth they would take home. For minors, you can still provide the details of minors, but you are required to disclose either a guardian or a personal representative in the event that something happens to you before they become adults. Okay. So when a member of a pension scheme passes on, the trustees of that fund are obligated to engage the nominated beneficiaries. That is, if they are aware of the passing on. Normally, of course, the beneficiaries or the next of kin would notify the board of trustees of that fund. The trustees will review the nominated beneficiaries. They will engage them and transfer the net worth based on the allocation. In the event that a member had actually not nominated those beneficiaries, the law grants power to the board of trustees to determine who are the beneficiaries of that fund. And normally they would look at history, they would look at records of next of kin, dependency relationship, and then make a decision based on that. And if the beneficiaries are minor, normally the board of trustees would seek what we call trusts in the market, get the best, and then transfer the money into those trusts for the upkeep of the children until when they attain adult age, and then the funds are transferred to them as required. Right. But there are some members who, at the point they are nominating beneficiaries, they even specify they want the money to go to a trust in the unfortunate event they pass on.
Okay. I hope we've been answered. On income replacement ratio,
yes,
is 20% IRR sufficient if there are other sources of funding like investment in farming, MMF, and equity markets?
Yes. The question is, if you amalgamate all these sources, assuming you have 20% in pension, then you have another equivalent of 5 million or 10 million in investments. And if you get the monthly income from it, it is equivalent to 60%, then I don't think there's a problem. You could be getting dividends or income from bonds, or you have a business, or you have rental income, for as long as the total or the amalgamated amount comes to an equivalent of the 60% or higher as provided, then it's okay. In fact, in my life through pension, or rather for the organization I work with, I have seen people who earn monthly income of as high as between 500,000 to 700,000 a month, because they consistently had their agenda right from the beginning until the point they retire. In fact, they have so much money they don't know what to do with it.
Wow. Okay. I hope you've been answered, Lennox. And if we could kindly ask you to keep your mic mute for some time. The other question is from Monene. Is it a must that the employer contributes? if the employee wants to join a scheme?
The answer is no. Pension, occupational or employer-based pension schemes are voluntary in nature in Kenya. A few years ago in 2013, the new NSSF Act had intended to make it mandatory, but of course there was a stay on the act.
Mm-hmm.
I know from this year's budget proposal, the government is working on what we call a national pensions policy, where they are likely to go that direction on making it mandatory for everyone. But ultimately what will happen is that you will perhaps not be required to do contributions exclusively to NSSF, but to any other registered player for as long as it is recognized by law.
All right.
But for now, it is voluntary. So if the employer does not have capacity, or does not have financial viability, they cannot. And that can clearly be outlined, or rather has been seen with the current COVID situation, where many employers have suspended pension benefits because they cannot fund the obligation.
Yeah. Mm-hmm. All right. Monene, I hope you've been answered. From Mulwa, Ruth, please explain some of the fund managers who can assist with estate planning to ensure smooth succession.
Sorry, perhaps what I will do at the end of this session is I will share my contacts,
yeah,
so that I can get in touch with him for more information.
All right. And
yes.
Also for Mulwa, we will be discussing succession and estate planning next week. So you can also join us. Yeah. The other question is, what revenues are available for just a minute. What avenues are available for employers who discover that part of their premiums are not remitted to the fund by the employer? Okay, part of available for employees who discover that part of their premiums are not remitted to the fund by the employer.
That's a very, very good question. And that is the information I was talking about. Many people contribute into a pension fund without necessarily understanding where the money, or rather the right contributions, have been deducted. That is point one, because on a monthly basis, the employer deducts the pension obligation and remits it. So the first reference point is you as an employee. Do you check to confirm that the amount deducted on your payslip is equivalent to what is remitted to your pension account? That is one. Two, remember in your contract of employment, there is a promised percentage of your salary which an employer is going to match and contribute. So the second thing is to confirm whether, if you are promised 10%, whether that 10% is being deducted. Because you find the employers where, yes, they are deducting and remitting, but they had promised you 10%, but now they are remitting 5% and they did not notify you of the change. And finally, there is where you find at the end of a given period, once you receive your statement, you realize the employer has not been remitted. Ideally, from the service providers who are mandated to manage your fund would be the first point of whistleblowing, because on a quarterly basis, we are required to submit or file returns showing how much has been remitted, how much is pending, or rather how much is unpaid, and what is the rate of return that has been declared. So consistently, if in a period of 6 months your employer has not been remitting, they should have written to your employer and the board of trustees seeking a remedial action in terms of how they intend to bridge that gap. If you follow up with your employer and your board and you're not able to get a confirmation or rather you are not satisfied with the request, you follow up with the Retirement Benefits Authority. But normally, by the time you're following up with the regulator, make sure you have documented evidence in terms of your request and why you are not certain that the response is satisfactory. The Retirement Benefits Authority also have a whistleblower portal where if you feel you are going to be victimized by your employer, just drop in a message anonymously and they will follow up on the case.
All right. Lennox, I hope you have been answered. Any more questions? But in the meantime, Ruth, you can give us your email address.
Yes, I'm just trying to populate it. I think I had forgotten, sorry.
Okay, it's all right. So for any further questions, you can reach out to Ruth. She will guide you on, pension, how to go about it, if you want to start, how to start. As I said earlier before Ruth started on, I said, I'd mentioned about our parents. Let's not be like our parents, maybe, perhaps. I think this is the only generation that we are in. Yeah, there are her email. That's her email address here.
My contact details are ruth.njuguna@octagonafrica.com, but you can reach out to me on my cell phone in red.
Yeah. All right. Okay. So as I said earlier, I think this is the only generation that we have. I'm not sure whether the kids we are going to be raising are going to be taking care of us. I think, unfortunately, we are raising them to be more independent and even financially. So they will be working for their money, a little bit independent and a little bit selfish. Yeah. So they will be working for their money. So there is no way we are going to retire and start asking them for handouts. So it's up to us to actually figure out how we are going to retire. In our gray days, how do I want to go home? Yeah. So yes, thank you very much for joining us. And thank you so much, Ruth, for agreeing to do this session. We shall share the presentation with everybody at the end of this training.
Yes.
Yes. Asanteni sana, and you can get in touch with Ruth. The email is at ruth.njuguna@octagonafrica.com. The telephone number is 0723 775 8621. Asanteni sana, and you are free to leave the meeting. As I said, next week we are going to be handling succession and estate planning. So karibuni pia. Asanteni.